Hello and welcome to Double Edge. How do you identify great companies? That's the big question that every value investor wants to ask. Saurabh Mukherjea, the author of The Unusual Billionaires, has attempted that answer with some very interesting results. Saurabh, thank you very much for joining us. Saurabh is the CEO of Institutional Equities at Ambit Capital. Saurabh, so first of all, let me ask you, why a title called Unusual Billionaires? The book is more about the people or the companies themselves.
Sure. So look, when I look at the sort of popular discourse in Indian media about corporate life, and this struck me 3 years ago, you either hear in the media sort of great deal of criticism of corporates who have defaulted on their bank loans, and there's lots of public agony and angst about it, or you hear celebration of an overnight success, somebody who's built something in a year and raised $1 gazillion from a private equity fund. What you don't tend to hear about is the stories of a typical Indian corporate who's worked hard for 10, 20, 30 years and gradually built a multi-billion-dollar business, created lots of jobs, created a great set of products that we use in our day-to-day lives. And what struck me was that the fact that the normal corporate who does a good job doesn't actually get media discussion, media space, was quite strange. So I set out to look for these people, and when I found them, I realized that one of the reasons that they don't get celebrated in the media is they don't seek the media limelight. They are focused individuals, hardworking people, and they're unusual in that they don't go out and seek the limelight and try to beat the drum.
So if I were to look at the companies, you've got Asian Paints, Berger Paints, Page Industries, a company that manufactures chlorinated polyvinyl chloride? PVC. CPVC,
pipes,
and called Astral Poly, Axis Bank, HDFC Bank. So some names are known because they're brands and there's a consumer touch, but these are not companies that you normally would think of.
Sure.
Why is that?
So what people don't realize is that a lot of the corporates who have consistently delivered sensible revenue growth and sensible ROC over the last 20 years, the numbers are very few actually. So if you look at the last decade or so in India, corporates who have consistently grown their revenues at 10% or better, and corporates who have generated return on capital employed of 15% or better, there's only a handful of companies, 15 to 20, who've pulled this off in the last
and that was your filter amongst the many filters that you applied.
And remember, we've got 5,000 listed companies in India, we've got 1,500 companies bigger than $100 million, and yet the numbers who pull off sensible results over a 10-year period are very few. Now what happens is several of the better known corporates, right, the iconic corporates of India, don't pass the double filter, right, and they are well known and they're celebrated and their market caps are huge, I can't deny all of that, but they don't actually pass the basic filters that I set for what I think it means to be a great corporate. The analogy I can give from the cricketing world is, say Rahul Dravid during his career wasn't celebrated to the extent he should have been, because during his playing career he outscored Sachin Tendulkar. Right? We rightly celebrate the Tendulkars and other spectacular players from the noughties, but what we don't realize is that Rahul Dravid outscored all of them during his career and delivered greater value for the Indian cricket team in inverted commas than almost anybody. The corporates I've sought to identify are the Rahul Dravids of the corporate world.
And not Tendulkars, and therefore not so, not prone to flashes. So the counterfactual question is, why are some companies not here? So why is a Reliance Industries not here? Why is an Infosys not here? Why is HDFC as opposed to HDFC Bank not here?
So in most cases,
or Wipro for that matter.
So in almost all of those cases, they haven't been able to pass those double filters, 15% or better return on capital employed and 10% or better revenue growth over the last 10-20 years. HDFC did pass the test, but the trend I saw in the numbers was not looking the right shape, and hence, as I say in chapter 1 of the book, on balance I left HDFC out. But the rest of the other corporates you mentioned and several other very well-known corporates don't pass the simple double filter I set out with.
Right. And the other interesting thing is that there seems to be no industry commonality except paints, which of course one would have not thought of in any case.
Yeah. So the commonality, you're right, Govind, the commonality is more in the behaviors of the companies, this ability to focus on the same thing decade after decade, the ability to constantly improve the business little at a time each quarter, and over time build a great business. It's the traits of the companies where the commonality lies, as opposed to their industry classification.
Right, and many of these companies have transcended generations. So is one of those factors how they've managed to, let's say, pass on managerial capability from one generation to the next, and maybe then in the hands of professionals?
We make a very fair point. An Asian paint spectacularly has transcended generations. Marico is going through generational change, so to speak, at the moment. And yes, one of the things that great companies I think do better than others is they build a core engine for the business, both around specific people, around processes, around the brand. And that core engine is so strong that it allows them to weather. It allows them to weather change at the top level. So Axis Bank, for example, is in the book, and in its 20 years of existence, Axis has had 3 different managing directors who are utterly different from each other, and yet the bank has delivered through that 20-year period, and in fact
including a tumultuous shift over.
That's right, and they've had sort of decadal periods where they've almost outgunned every other bank in the country. And then they've had 2 or 3 years of turmoil, and yet they have pulled through. So the ability to have a strong core engine, processes, brand, people, is central to the greatness of the companies mentioned here.
Right. So if I were to ask you now that if you picking companies like this, I mean, or identifying good managements going ahead, what would be the toolkit like?
So my point of view has been in the book that for the average investor out there, who's got a difficult day job and can only spare a few minutes for investing in a given day, these 2 filters do a very good job. Look at revenue growth over a long period of time. I've suggested 10 years, 10% revenue growth over 10 years. Look at 15% ROC over the last 10 years. And what I've highlighted in the book and I've shown in great detail is if you do this any time in the last 16 years, what history shows is you do this any time in the last 16 years, buy the stocks which pass the double filter,
and they return better than the Sensex.
Sit on it for 10 years untouched. You make way more money than the Sensex, and your portfolio has lower risk characteristics than the Sensex itself. So for a retail investor who wants to take a prudent, long-term, risk-averse approach to investing, I think looking at these double filters is a good way forward. For the expert investor, they can always take the double filters, look at the output, and improve it further.
So at the end of whatever that period is in one's mind, should one exit, churn, or should one be happy with dividend?
Sure. So my strategy is buy a bunch of great companies at a point in time, sit on it untouched for a decade, then cash out and begin the clock again.
Okay.
Right? Because over a 10-year period, India does change radically. What worked 10 years ago doesn't necessarily need to work over the next 10 years, and hence take the decadal leap, keep the portfolio untouched. History suggests you'll make a great deal of money, and then cash out and begin the clock again.
Right. But I mean, a more behavioral question. Do you think investors today are in the frame of mind to take decadal bets as we...
They aren't, and hence the book. So the 2 secrets of making money in the stock market, as I have sort of learned it from my gurus, is that you identify good companies and then you show a great deal of patience, right? There are, as far as I know, there is no other shortcut to getting rich quick. And these are sort of, whether it's Warren Buffett, whether it is Seth Klarman, or you look at almost any of the legends, this is the 2-pronged approach. Great companies, long periods of time. What I have done, to be very modest about it, is simply taken that wisdom and translated it into this what I call the coffee can portfolio. 10% revenue growth, 15% ROC. That's my filter for good companies. Long periods of time. I've said sit tight for 10 years. Warren Buffett would say forever. I don't think your viewers quite have the luxury forever. So if you can't pull that off, good companies, long periods of time, it is difficult to make money in the stock market, and hence short-term trading and lack of patience suggests you're better off not going into the stock market.
So and we are also, since you referred to media, you talked about companies which don't seek attention, and on the other hand you're inundated with the valuations of e-commerce companies, unicorns. Yeah. How does that entire world fit with what you're writing?
So it is entirely feasible within that 10 years out. We might have companies who are e-commerce companies and who are unusual billionaires in the 10% revenue growth and 15% ROCE sense. However, if history is any guide, if the last 15-20 years, especially what's happened in America is any guide, we will be able to count on the fingers of one hand those companies, because it does seem to be difficult in the context of e-commerce, whether it's in the States or in India, to deliver the sort of performance highlighted here. Even more specifically, what America is teaching us is, what the American e-commerce market, which is a more mature market than ours, is teaching us, is that the winners will be very, very few and the losers will be several. And for me to sit here and pretend that in the listed or unlisted context, I can find the winners would be for me to pretend that I can see tomorrow, which I can't. So yes, there will be e-commerce stars of tomorrow, but the odds are at the moment stacked firmly against them to deliver the sort of performance that you would need to make it to this book 10 years hence.
Right. So, Mama, in your toolkit, you've talked about 4 or 5 things. You've talked about the dependence on government regulation when identifying companies, competitive intensity, capital intensity, dependence on economic cycles, and more importantly or usefully, you've talked about good governance and clean accounting. How important is this factor when it, I remember when the whole Infosys and the IT story started, one of the biggest factors going in their favor was good governance and clean accounting.
Yeah. So the way I look at it is, in the BSE 500s, 500 largest stocks, our reckoning is half of the BSE 500 has subpar accounts and the other half has clean accounts. Those who have subpar accounts, my work suggests those who have subpar accounts clearly deprive their shareholders of returns by dint of their poor governance and accounting. Amongst those who have clean accounts per se doesn't mean your shareholder will make money, but it's an important hygiene factor. So clean accounts, the way I would put it is, clean accounts are necessary but not sufficient for you to deliver money for your shareholders. If you have dodgy accounts, you surely will cost your shareholders money. So insofar as that is the case, annual report reading and looking for quirks in the annual report which would point to substandard accounting really is worth looking out for. Again, to use my filter, 10% revenue growth and 15% ROC. Over a decade, if a company delivers that, the odds are pretty high that the numbers are actually real. So one of the benefits of looking at a 10-year track record is you're weeding out the dodgy accounting guys.
So last question. So when you prepare your own list, which is entirely driven, let's say statistically or numerically, what is the companies that you felt in your own mind should have been there but didn't make it to your list? Yeah.
So I was, if you ask me, had I not done the crunch, I would have thought Sun Pharma would have made it, but I was surprised to see that they didn't actually pull through. Motherson Sumi has been a celebrated stock over the last 4 or 5 years. I was curious to see they also miss out because their ROCs dipped for a couple of years. A lot of people, including myself, would have thought HUL would have made it, and they weren't able to.
And yet Marico did,
Marico did, and HUL didn't, right? Largely because a 10% revenue growth every year in FMCG is actually very hard. So it's always good that rather than using our hunches and our intuition, we rely on cold numbers. And I use this guardrail, this double guardrail of revenue growth and ROC to both discipline my own approach to investing and to produce something which I hope your readers find useful, in that it's a simple approach to investing which seems to generate profitable results fairly consistently.
So absolutely last question. So the Indian economy is growing, and we may grow let's say 8% in the coming year and may even grow faster than that. How much does economic growth at the very fundamental level have to do with the performance of these companies? I know you're addressing it in the book, but tell us.
So I think one way to look at it is, if you look at the 16 coffee can portfolios in the book, one for every year starting 2000, 2001, what's very interesting is back in 2001, 2002, when we used to struggle to grow at 8%, there would be barely 12 to 15 companies that would make it to the portfolio. Now that we've had a good decade of healthy growth rates, I know we dipped down to 5, but we've had a good decade of healthy growth rates. What's interesting is it's more like 20 companies who pass my double filter. So the benefits of sustained economic growth will be more and more companies should be able to pass my double filter of 10% rev growth and 15% ROC if GDP growth stays at the 8-9% levels for an elongated period of time.
Your sample expands, but it doesn't disappear assuming growth were to shrink.
If growth shrinks,
if growth expands, then the sample expands. But even if growth were to shrink, then you still have a sample.
But because what the 90s showed us was, even at the end of the 90s, we had a dozen companies who passed the test, and interestingly, even if you bought those stocks right at the top of the dot-com boom, right? Think of the power. You bought those stocks which did well which delivered results over the 90s, right at the top of the dot-com boom. 10 years later, in 2010, you would have still outgunned the Sensex fairly brutally, and compounded around close to 20 to 23% over 10 years. That's close to 8x your money over a 10-year period.
Right, and that's a wonderful note to end on. Saurabh, thank you very much for speaking this, and all the best for your book.
Thanks a lot.
Thank you.